A lot of startups who actually were selling beautiful PowerPoint dreams raised a lot more money and eventually did not survive.
10 years ago, it was an unsolvable problem. I come forward 10 years. The gap still remains if it hasn't actually increased. In emerging markets, it looks worse. But I don't want you to go 10 years in the future. Just a couple of years from now, are we going to constantly remain in this underserved debate?
When you have a startup, you have nothing. You have no VC money to build your organization. You have no professionals to convince them to join, and you have no institutional money to do lending. And unfortunately, all of them want to hear a different story. So the VC wants to hear a very beautiful, high-tech, jazzy story. They wanted to hear we are connected everywhere, everything is happening using AI, big data, etc. The bank wants to hear exactly the opposite.
Welcome to today's episode of Couchonomics with Arjun. This is yet another one of those virtual episodes that we're doing a lot more of this season because we wanted to get the voice of the wider world. Obviously, we'll try and contextualize it to the MENA region as much as possible. Joining me virtually from Singapore is Nikhilesh. Nikhilesh is the CEO and co-founder of Validus. They're a player who focuses on the sort of the underserved SME segment. But rather than me try and tell you everything about Validus, I guess let me first welcome Nikhilesh to the show. Nikhilesh, welcome to Couchonomics.
Hey, thanks, Arjun, for the opportunity. I've seen a lot of the episodes and really excited to be here.
All right. Well, that's very kind of you to say that you have seen some of the episodes. I now know 3 people who have. So at least I have an audience of 3. So, Nikhilesh, we haven't met ever. You were introduced to me by, I guess, a fellow friend. So I appreciate you, taking on the invitation. A lot of people tend to avoid it, but, thanks a lot. I guess the first question is, for the audience, because I do tend to have a bit of a MENA-centric or MEA-centric sort of population, it'd be great to sort of understand what does Validus do? Where was the genesis of the idea? Where did it come from? And how did you go about setting the business up?
Sure. Validus today is Southeast Asia's largest digital SME financing platform. We aggregate capital from institutional investors, mainly banks and non-bank financing companies in the region, channel the monies to small business borrowers across the Southeast Asian region by way of what we call anchor financing partnerships.
Okay.
We've been around for close to 10 years. We have done a little over US dollars 5 billion in lending and growing strong.
And when you say you use the word Southeast Asia, or do you say Asia? You say Southeast Asia.
Southeast Asia.
Which markets are you operating in already?
Currently, we are operating in Indonesia and Thailand. We were also operating in Singapore, but that's a business we sold last month to one of the leading digital banks in Singapore.
Okay. So, and 10 years ago, right? So 10 years ago, I guess you guys were, if I may say, pioneers or trendsetters, both in terms of the word FinTech, if I may use that term, and definitely for the SME financing. So what brought you to it? Like, what was that sort of moment in time where you sort of woke up one morning and said, I'm going to solve this problem?
I think the wake up and let's do something had been around for a while. Mm-hmm. It was about what problem and when's the right time. Now, if we think about the underserved SME financing opportunity exists across the world, almost every single country. Mm-hmm. However, very few have managed to crack it, right? A lot of investors actually refer to it almost as the unsolvable problem. For us, the moment when we decided to jump in was the advent of the peer-to-peer lending model in Southeast Asia, right? Because only when you have access to capital can you think about solving a lending problem.
Okay.
So the P2P model emerged in the UK, went to the US, China took it and ran with it in a very big way. It started to crop up in Southeast Asia around 2015, 2016. And that is when Validus and a few other competitors decided to jump in, use the model to access capital to do small business lending. But as we go deeper into the conversation, I would love to share that, look, that was the genesis. That model was just a means to access capital, wasn't solving the entire problem by itself.
And okay, so I've got a couple of questions. So correct me if I'm not wrong. We've all heard about the China P2P story, but it didn't end really well either. In the sense, I'm not suggesting it's ever ended, right? But in the sense, it kind of grew quite exponentially, and then we kind of got to this moment which was pretty ugly, right? Did that not cast a dark sort of shadow as you guys were coming around, or did your timing was sort of after the problems in China had been sort of ratified or I guess improved?
So luckily for us, when we jumped in, the China story was growing really well.
Okay.
P2P lending companies were doing incredibly well. It's somewhere, I think, around 2017, 18 is when the China model started to unravel.
Exactly.
But
Yeah.
for a very single particular reason, which was the entire industry has front run regulations.
Mm-hmm.
And rather than build regulations around an industry which had become too difficult or too big to control, the powers to be in China decided to just shut it down. Luckily for us in Southeast Asia, the regulators moved very quickly. Also, sometimes not being an early mover is an advantage
Mm-hmm.
because the ecosystem evolves. And by the time we really started growing our business, majority of the markets in Southeast Asia had very clear digital lending regulations around it. So in all the markets that we operate, we are fully licensed under the aegis of the central bank, and that really makes all the difference in the world.
Okay. All right. So now let me ask you a question. I guess it's an extension to what you just said. You used the word an unsolvable problem. I like that. Right. I'm going to use that again. Right. 10 years ago, it was an unsolvable problem. Right. I come forward 10 years. Right. In my humble opinion, the gap still remains if it hasn't actually increased. In emerging markets, it looks worse, right? Um, we've seen a number of players, Validus and others, who have been brave enough to sort of come in, solve for it. There are a number of digital banks which have emerged who have tried to lead on the SME story, right? Two parts to this question. A, how have you seen the landscape evolve over the last 10 years? So, what have been the most significant shifts that you've seen? And we can talk from a Southeast Asia context or a global context. And then I want you to kind of sort of put a crystal ball, but I don't want you to go 10 years in the future. I'm sort of just a couple of years from now. Where do you see that significant shift will ever happen? Or are we going to constantly remain in this underserved sort of, debate that we constantly have?
Oh, I think this is honestly a few episodes by itself, you know, because it's a really interesting question. And I think in the 10-year journey, we have seen almost the first part of a full cycle, right? So we started when SME lending was talked about, but hardly any players. Then we saw the first phase where a lot of players rushed in simply because there was some regulation to allow or facilitate entry into a sector, and a lot of venture capital flowed into the industry.
Mm-hmm.
We saw the second phase where a lot of these players started going bust. For whatever reason, some could not scale up and therefore got starved of capital. Some could not manage the risk. NPLs really threw them off track. And in Southeast Asia, we've also seen a few corporate governance issues because lending is one of the few businesses where the product is money,
Yep.
right? Hence, misuse is unfortunately rampant. And therefore, we are today what I would call in the last leg of chapter one, where there are very few dedicated players operating in the industry. Those who are have achieved some kind of scale, legitimacy, and therefore probably the next decade is going to be very different, right? Which will be less about finding the next business model, but more about solidifying it, scaling up, and showing that look, we can build a book that is not of a few billion dollars.
Okay. Good point. That leads to a couple of questions. So you can answer this from a Validus perspective or an industry perspective, right? So there are a number of parts to the equation you need to kind of get right in this segment. The first part is, the access to, I guess, available capital to be able to deploy, right? Obviously, access to good risk, right? There is abundance of need, but I will come back to it. A lot of people avoid it, and some of the good people who can pay back tend to sort of avoid it because they have this sort of fear of rejection. But we'll get to that later. But there's access to the need. There's technology in the middle, which sort of enables the journey, the matching, the credit underwriting. And then there is this sort of post, if I may take the post event exercise, which is around collections, right? Which could be both just normal collections, but sometimes you have delays and bad debt and so on and so forth, right? How do you solve for this problem? How's Validus sort of solve for this problem? Because I'm assuming, are you profitable? Are you not talking about that right now? Do you make money?
I'm very comfortable talking about everything.
Right. Okay. Well, then how have you solved this problem to appear, 10 years is a reasonable amount of time in this business. A lot of business sort of fall by the wayside or pivot their model and so on and so forth in 2-3 years, right? Have you got every part of this equation right, or is there one or two parts where you guys have really mastered it?
I think, look, right off the block, nobody's got everything right. We are building it as we go along, right? So when we started off, we jumped into the problem headlong, saying, let's solve the SME lending problem, right? SMEs are underserved. As naive as we were, we thought banks do not lend to SMEs because they cannot do good ratio analysis. Jumped into it, spent about a year, and figured that no, the problem is a lot more difficult. And there were three fundamental challenges we needed to solve. The first is, how do you get access to credit-worthy SMEs? Because when you are putting ads on Facebook, Instagram, SMEs are not clicking there or Googling, how do I get a loan? The second is, when an SME lands up at your doorstep, how do you do the credit evaluation?
Mm-hmm.
Right? And that is the primary reason why banks, large institutions don't lend to them, because either they don't have credible financial statements or any information they give to you cannot be trusted. And therefore, you can build the best algorithm in the world, but garbage in is garbage out.
Mm-hmm.
And the third is solving a problem of credibility, right? Which is, you can have a great group of SMEs, you can have the best credit algo in the world, but if you're not a bank, you don't have access to captive capital. And therefore, where do you, like you rightly said, where do you get hundreds of millions of dollars to lend out to these SMEs and grow? And after trying a few different business models, we went back to probably one of the oldest plays in the book, saying, let's do supply chain financing.
Okay.
But we put our own spin on it. And that was, let's go and partner with medium and large corporates in Southeast Asia, ones who are focusing on consumption linked to the middle class, right? So this could be food, pharmaceutical, FMCG, anything that the middle class is consuming on a daily basis. From them, get access to all their suppliers, vendors, dealers, and distributors. Why? Because supply chain in Southeast Asia is fragmented. A product doesn't go from Unilever to supermarket. It goes via a distributor, sub-distributor, reseller, wholesaler, etc. Use this data to do the underwriting, right? And why can you use it? One, because the data is coming now not from the borrower, but your anchor partner.
Mm-hmm.
Hence, it is trustable, right? You can get enough vintages or cycles of data, right, that you can build credible models around it and then do lending. And that again leads to the third part of the problem, which is, the moment you start playing in large corporate supply chains, there is a lot of credibility built around the business. You can build your initial loan book, which is very safe, without doing anything funky, build a 2-3 year track record, then go to the banks and say, look, this is a model that is really scalable. And what we found is, across Southeast Asia, banks are extremely hungry to get access to this asset class. All they needed was a credible model to back. And today, over 90% of our capital comes from banks, both local, onshore in the respective countries we operate, as well as global.
So Nikhilesh, so it begs the question, right? So supply chain financing using, I guess, anchor clients, which call it Unilever. We don't want to call Unilever, but I get the Unilever.
Just a placeholder name.
It's just a name, right? Great idea. I've seen a number of businesses globally do this, right? I have to ask you the question: why aren't the banks just doing it themselves? Because Unilever is their client, right? 9 out of 10 times. This is the reason that Unilever gets on board with you, is because it solves their underlying problem for them, because they want a healthy supply chain for their business to get sorted, right? The capital is in any case coming out of the bank, right? So why this inertia not to just solve for this? Because I don't see this as the most creative problem to have solved, right? I can understand where it's the hunting in the wild, wild west of SMEs, right? Why have the banks not solved for it?
Wonderful question, sir. So we need to understand that, like they say, that it's never about the strategy or the business model. It's about execution, right? And what does that mean? What I have understood, and I've never worked in a bank, right? Having worked with bankers on the other side, what I have understood, that banks are in the business of risk-free lending. And what does that mean? That if, let's say, theoretically, a bank goes and talks to a Unilever and says, I need to lend to your distributors, they will want recourse on Unilever. saying, look, if any of them do not pay, I want a guarantee from you, right? So there will be models where this particular anchor might give a guarantee, and banks will happily lend to that ecosystem. However, in majority of such businesses, the anchor says, look, it is not my job to give a guarantee for these distributors. That is not my business model, right? Now, the moment the bank has recourse only to the small distributor or sub distributor, then they need to do credit analysis on that small company like they would do for any other large corporate, which means you need 2 3 years of P&L and balance sheet and cash flow ratio analysis, etc., which often doesn't work out. Using alternate data, right, which basically is historical transaction data, facility flow, transaction flow, is still not given enough weightages under the traditional underwriting models of the banks. So the end answer generally is, look, I can't underwrite you. Do you have land, building, house, warehouse to pledge so I can give you some money? If not, sorry, I can't do unsecured lending.
And why would they take the risk with you then?
Yeah, so they can take a risk for us for 2 3 different reasons, which is okay. This is where it gets a little controversial, right? Is that, look, there is ultimately nothing like a bank or a corporate. There are only departments and people. Each one has a box drawn in saying what is it they can do. Risk does risk, compliance does compliance, sales does sales, and they have their own KPIs and agendas.
And so you
Right.
speak to the right
So
department in the bank.
sometimes it is a lot easier for a bank to say that, look, there is a fintech who is executing this. I have track record for at least 3 to 4 years. I can see they are operating. They have done a few $1 billion of lending at 1% NPL. I will do it through them, then do it by myself. Part two is just the industries that we operate in are fast moving industries,
Sure.
which means a customer comes back for a reloan every 45 to 60 days.
Okay.
Which means you have to redo the entire process every 45 to 60 days. If a bank has to do it traditionally, which is come to my branch, submit docs to an RM who goes to a credit officer, branch officer, the number of physical hands touching that application is too much. And therefore, the cost of processing just does not yield the unit economics that you need. Being a fintech, we do all of this using technology which is completely paperless.
And do you see
And therefore, we
yourselves
can
being
operate at a margin that the model requires.
but do you see yourself getting sort of well, you've already sold your Singapore business to a bank. So do you eventually see banks going, something, we'll integrate these guys, right? Let this come within the within the purview of the bank, or do you think they will prefer running this model, which is an arm's distance? Let the fintech do fintech, and we'll just basically give credit.
Okay, I mean, we can talk about the Singapore sale. That was a slightly different story why we did it. Our experience, at least in Indonesia, we work with all the top five local banks.
Okay.
If you sort banks by AUM, all five work with us. All in all, we have close to 10 banks that we work with. And we find great appetite. Of course, the product, the economics, the regulatory angle, everything has to work for it. So till now, we have seen a couple of banks trying to build the product themselves. However, we have not seen anyone find real success in it.
Okay.
Also, if you think from a bank's perspective, they still make the yield that they need to make. They have one person monitoring the portfolio versus an entire department mobilized to run it. So I think as long as the product continues to do well, I do not see a need for disintermediation.
Fair enough. Let me ask a question. It might not be relevant to Validus, but it'll be interesting to hear your view from an industry perspective also. So supply chain financing through an anchor investor, great. I'm sure there's ample opportunity to continue growing that business model, right? But there is a significant market out there which cannot get served by this model for whatever reason. Either we don't find anchors, or they don't have that sort of serious anchoring into one sort of provider, and sort of have to fight for their money every day, right? How do you see? So, firstly, do you see that as a natural extension of your business, or you're saying something, there's still ample opportunity to grow, so we don't really need to see it? So that's my first part of the question: is how do you see that sort of market evolving? Because I'm assuming that that's a bigger, more significant share of the market. And the second part of this question here is that increasingly, when I do have conversations with, your peer group globally, people talk about saying that, if we want to build stickier relationships and de-risk the relationship further, we start building some other capabilities around the core offering of just lending. Uh, Sometimes as a defensive strategy, sometimes as an offensive strategy, right? Without actually becoming a full-fledged bank, right? Uh, your views on that too. Do you see that as a model that increasingly players like you will adopt? And have you started adopting, or do you think it's a highly selective sort of view to whether or not people go down that
Sure.
way?
Let's take the first one, right?
Yeah.
Which is, let's talk about businesses, and there are millions of them who are not part of any kind of a corporate supply chain,
Hmm.
right? These could be freelancer or solo, so what we call solopreneur kind of businesses, right?
Solopreneurs.
Every small restaurant, every, let's say, small merchant shop, a standalone plumber, carpenter, etc. Right. Now, for some markets, we have built products, right, which are completely developed using machine learning, where we ask the borrower only for three documents, which is their bank statements, which are in a machine readable format, so no human interaction, personal credit bureau history, and KYC information, and build algos to just do small ticket lending using that.
Hmm.
Right? It's an interesting product. It's a high yield product, right? It cannot be done at, I would say, SME rates. It's more for the micro segment, and it's done well. However, given the opportunity within the supply chain space is very big, we prefer to focus there, right? So maybe an honest answer to your question is there are products we have built, people are trying to build. I haven't seen anybody do it at scale, right? I mean, would we do $5-10 million of that product a month? Yes, right? Can we go and suddenly increase throughput to 500 million? Don't have the courage today,
And I
right?
agree with you because there is the aggregation challenge, there's the cost to sale challenge, the pitch to your credit providers is incredibly different. And as you start to scale the operating model, it starts to look very, very different, right? Because I find it quite perverse. We in the Middle East have seen a plethora of these revenue based lenders who've come up. And I keep going, I'm like, guys, what revenue based lenders? These guys, most of them are solopreneurs. They've under 3 years of business, 2 years of business. Most of the returns, these guys were transacting as individuals. They weren't even fully certified businesses, right? So let's not just keep talking about revenue based lending, right? Invoice factoring again, is safer because arguably you're factoring against it, right? Try and answer the second part of this question, and maybe you'll have to give me a bit of an industry view. But even from a Validus perspective, do you see any need to start building a range of services which is beyond just the credit that you offer to these businesses, which arguably will allow you to expand your relationship on the credit side, also provide you a little bit more defense? I know 1% NPL is awesome, so I don't know how much further can you actually take it down, but not everybody's in that same situation. How's the market shifting?
See, look, there are two ways to look at this. One is if you are the owner of an existing ecosystem, right? So if you look at Alibaba, on the back of that monster, they built Ant Financial and then My Bank, right? Where if you have Alibaba history, one click, you share it, immediate credit approval, etc. If you look at companies like Square, Stripe, right? I know T Square, I think, has built a very strong lending business. So if you have very strong transactional flow, you can build a business around it, right? Which is somewhere the thesis behind with a C group is building money, or Maribank and a Grab is building their own financial services business. The problem, if you flip it, is much more difficult. Saying, look, I am doing lending. Can I now build an ecosystem around it? Right. So we have seen people trying to do it. Right. My own personal take is yes, you can try to do these things. At what point should you do it? You try to do it too early in your journey, where the core business itself is not what I call a cash flow generating monster. You spread yourself too thin, where you have many small pieces, each of which are subscale.
Okay. But could I not argue the other side around, which is to grow that cash flow in the core business, you might need those bells and whistles because otherwise you are just one of many?
Like I said, Arjun, right? It's always a question of timing,
Mhm.
right? Now, if you are a startup, you have limited resources, right? Resources is capital, resources is People, bandwidth, execution capability, right? And as a founder, you're always asking yourself, where do I need to spend it?
Okay.
Right? Yes, I can do two, three things, but right. And the other thing, or the other question is, yes, there are a lot of people building a lot of things, and there's a lot of hype around it, but where is the scale? Right? For example, let's talk about embedded finance. Right? It's like blockchain. Right? Blockchain was going to completely change the world a few decades ago, and it still is in the process. So just like that is embedded finance. Now, for a small business, especially for that solopreneur segment that we're talking about, right? What tech systems are they using? Nothing. Even if you look at the payment landscape across Southeast Asia, if you walk into any, warung in Indonesia or a kirana shop as they call it, I would assume 50% is cash, then there would be credit cards, and then, the poor guy has two, three different POS machines, and with his mobile accepting at least 5 to 6 different payment wallets, cards, etc. Which means none of these payment guys are seeing more than 5 to 10% of the total transaction flows. How can you do lending on that basis?
Fair enough. No, fair
Right.
enough. And I
So
think
the
that
way I look at it is, I don't think there is a generational shift happening over the next few years, and therefore, you know, for anybody building a lending business, as long as the core business is growing well, and you don't think you're losing ground there, I would say just build that core business, right? Till that business is so large and stable that then you have the cash and the bandwidth to build an ecosystem around it.
so. Nikhilesh, I'm gonna go back in time a little bit. I just want to answer a question. How did you land at this anchor-based SME lending model? Because there are quite a few out there, right? So was that just by through trial and error, or was it because that was always the plan, or you guys come from that kind of background? How did you kind of land at that model?
Okay, no, I think it was purely through trial and error. So we started lending, saying we will find SMEs online, get bank statements from them, wrote a rudimentary credit algo, run it through it, and do lending. Realize that, look, as long as we are vetting each case thoroughly, yes, we can manage risks somewhat, but can we do that at $100 million a month throughput scale? Just no way, right? Then try to do broker-led origination. Different people call it different names. It's called DSA in India, broker-led in Singapore. Found the same challenges. Eventually realized that, look, I need to find a model where information is coming from third parties. Try to look for embedded finance, but realized that other than the big three e-commerce players, there were really no digital marketplaces that SMEs are using. Just nothing. There are no volumes anywhere.
Right.
And then went back to some of, then we started looking and saying that, look, let's forget tech models, or let's say the Alibaba, the my bank model was again just not relevant to us.
Mm-hmm.
So that's how we went back to the drawing board, saying, okay, what really works? And the answer was, if I can finance a transaction, at least I know where the money is going and who I am going to get repaid from. So that's how we got into bill discounting or invoice financing. Then, of course, that was part two. We started that, figured that, hey, what if somebody brings a fraudulent invoice? How do you check that? How do you ensure after you finance the invoice, you actually get repaid? Then we flip the problem, saying, rather than the borrower coming to us, why don't we go to the corporate and saying, you give me access to everybody who's in your supply chain? So, yes, it did cost us a few years trying to arrive there, but we didn't have a Silicon Valley model to copy. We got kicked around like a football till eventually accidentally finding ourselves, in the goal.
So I've got a quick question before I actually come to, because I do want to talk a little bit about Indonesia and Thailand, because they're very, very interesting markets. So am I to assume that the significant percentage, or nearly 100% of your clients or your customers are introduced to you by one or the other anchor partner? Is that
Yes.
sort of right?
Yeah.
So your
So
cost to
today we
customer
work with about 150 unique anchor partners in the region,
okay.
and 100% of our customer base is within their ecosystem.
And so does that preclude you to having build a direct relationship with those SMEs. You don't really have to go through the whole journey of building that trust and knowledge and know-how because you know that pretty much they're all coming in your direction? Or do you do spend a significant amount of time sort of saying, no, I do need to develop that relationship with the SME itself?
Oh, we definitely do.
Right.
We definitely do, right? Because what happens is from the anchor partner, we get a list of bona fide SMEs, right? We get data on them, and therefore fraud is weeded out. However, there is still the element of one educating the SMEs,
Mm-hmm.
right? Many of them do not understand what is invoice financing or how distributor financing works. The second is bringing them from the offline world to the online world,
Hmm.
right? Because unfortunately, we do not have branches. So, yes, we will have a relationship manager who will handhold them, get them onboarded the first time. But after that, it's a self service model
Hmm.
where they have to come online, apply, submit the documents, etc. So
Interesting.
there is definitely this element of relationship building. However, there is no element of sales, and that's what we tell people. Our RMs are RMs, right? They manage the relationship. They are not out there in the market hunting SMEs.
You know, you're very similar to a business that I came across a few years ago. And maybe I say that with confidence, having spoken to you for 20 minutes, but there you go. Let me see if I got this right, which was actually in Turkey. And it was very interesting. They were a completely sort of digitized invoice factoring player, right? But they had 450 RMs. Okay, and they also had anchor based lending. Not 100% was anchor based, but significant percentage was. But it was, I guess, how the market plays out. And when I kind of asked the question saying, why do you have 450 people sort of covering all of Turkey, and they said it is paramount for us to constantly educate, right, the SMEs. We collect more information on them, we build relationships. Some of the origination, actually, sometimes we get aware of much before the origination comes from the anchor investor because, their world is shifting. We don't know what's going on between the distributor. And he says sometimes they have multiple distributors. So actually, some of the SMEs have become introducers into anchors, smaller anchors, right? Because as you might realize in other markets, which I'm sure is the same case in Indonesia, which is actually quite a big country, and Thailand also not precluding isn't a small country. I'm gonna kind of switch to topics. I'm going to talk a little bit about regulation, right? So in a number of parts of the world, right, people sort of firmly point the finger at the regulator, saying the regulator hasn't made life easy enough for us to be sort of playing in this space, right? They expect us to deal with these SMEs in the same way as corporates, right? Some of the underwriting requirements are crazy. The credit bureaus don't have necessary amount of information that we require, et cetera, et cetera. Tell me about how do you see Indonesia and Thailand? How has the regulator evolved their position? Are they hindering? Are they helping? Are they agnostic? Where are they on the sort of the spectrum, if I may ask? I'm sorry I'm putting you on the spot.
Yeah, maybe I'll take a step back before that, Arjun,
Okay.
right? Which is we bucket broadly markets in three categories. The first is where there is just no regulation, right? Vietnam was one of those markets where we operated, waited for regulations to come for a very, very long time, eventually gave up on the market, right? Simply because the regulator just did not move, right? The second is a market where the regulator draws a box, right? Says, look, these are the regulations, this is how you need to operate, what is allowed, what is not allowed. But beyond creating a regulatory framework, does not really do anything to provide a boost to this fintech industry, right? Because everybody has to realize that, look, banks were given licenses to almost hoard or ring fence capital.
Mm-hmm.
Unless they release some of that capital, some of the information, fintechs will find it very difficult to survive. So just creating regulations is not enough, right? You have to spur growth. And third are markets who do both. So with that background, Indonesia is actually category three. Not only has the regulator drawn a very clear box, right, saying what are lending fintechs allowed to do, not do, right, what are the protecting mechanisms, minimum capital, fit and proper. They also have regulations which says that, look, banks need to have an X amount of their AUM under what is called productive lending.
Mm-hmm.
And if they can't do it themselves, they should partner with a fintech to do it.
Okay. Right. And
Right.
And you obviously go down the third market quite aggressively.
Yes.
Right. And where does Indonesia and Thailand sit on the spectrum on this? So what has the Indonesian regulator done, which has sort of created the market and growth for it?
Yes. Two things, right? The first, like I said, is made a very clear regulatory framework under which lending fintechs can operate,
Mm-hmm.
right? Which defines what is the minimum paid up capital, fit and proper criteria, etc. And the second is created broad rules which spur participation from the banks,
And Thailand's
right?
done the same thing.
Thailand is, I would say, it's in the works, where at least the governing model for lending fintechs is extremely clear. Participation from the banks, not there yet, but I know it's in the works.
Okay.
So we do have a couple of banking partners already, but I do know that there is a lot of movement happening to really spur the banks into action.
And where's the sort of the open banking, open finance spectrum in these two countries? And do you see that are these
Ah,
is
Look, yeah, the open banking is, I think, still very, very far away.
Mhm.
Yeah, open banking, open finance, I think is still very, very far away.
So you're doing all of this through bilateral relationships with anchors,
Everything.
with bilateral relationship with banks. Do banks actually share any data, or no? They're just purely playing the role of providing you credit.
Okay. I think it's an evolving relationship. So Indonesia is a very good example where when on day zero we started with some of the banks, it was purely a transactional relationship which said, look, you bring the loans, I will give you the money and you can do lending for me. Over time, we scaled some of those relationships to north of $100 million each. At which points the banks really started getting vested in this, where they said, hey, I have some of my clients who could be prospective anchors for you. Why don't I bring them to you so you can do supply chain financing for them? In turn, one, it will deepen my relationship with them. And two, whatever origination you do from there, I can become a lender on your platform and also participate there. So I think it's a little unrealistic to expect the banks to open up completely on day zero because it's, again, building relationship on that side also.
No, interesting, interesting. Let me switch gears. This is an interesting question and another debate which comes up, at least in the multiple markets that I've worked, which is this sort of sensitivity to price versus acceptance, right? From an SME perspective, right? Am I going to get the loan or not versus am I paying the price, right? Unfortunately, sometimes this evolves into what I call predatory pricing, right? Because the lender sort of positions him or herself like, we're here to save your skin. We're going to charge you what you are. The US is a horrible, horrible model for that, right? You have more, payday loan and small business lenders than you actually have big donor outlets, right? It's an interesting statistic. Where do you guys, where does that sort of line get drawn for lenders like you, where you sort of ethically say, no, this is not something that we should do? And I think you're in an amazing position because you could get into predatory pricing very easily because you have sort of a guarantee. There's no guarantee, but they have assurance that you're going to get paid, right? And there are people who need it, right? Competition is still there, but there's not 100 people competing, right? So where does that line, that ethical line get drawn?
Oh, I've never got that one before, right? So here's how I think about it, right? Which is there are certain models that can run very long on predatory pricing, right? But I believe the borrower there has to be extremely unsophisticated, right? Let's talk about the rural borrower or maybe a microfinance borrower or a very bottom of the pyramid solopreneur, right? Then there would be segments where you can charge very high interest rates, but I do not expect them to have repeat borrowing behavior, right? This could be consumer finance, where you are borrowing for child's education, there is a medical emergency, a wedding, etc., etc., where look, you need shock money, you are ready to pay 50% interest rates for that, but you don't expect it to be a recurring occurrence, right? And in those business models, you lend at 50%, you assume 10% of your book is going to blow, but you make enough of the remaining 90% and still have very high margins. Ours is a very different business model, right? Where once an SME start borrowing from us, they are not borrowing for an episodic or periodic use. They are borrowing their core working capital needs, and we want them to have very high repeat usage with us where they come back every single month as a cycle for years to come, which means our pricing has to be such that after paying us, they still have enough gross margin for them to take home something.
Fair enough.
Right? So even if I believe I have predating pricing power, I don't think so. Because after a couple of cycles, the SME will want to get out of this relationship and find some other source of funds. And yes, they might not get it from the bank, but they'll get it from friends and family. They will scale down the business. They will find a way to operate because they were operating before we existed.
Okay. And so that begs the question, which I need to understand and educate me a little bit. I've always believed that, SMEs specifically have two kinds of funding requirements. One is around liquidity, right? Which is, I need money now. It's not an issue with solvency. It's not growth capital. It's their equivalent of a wedding. It's their equivalent of a medical emergency, right? And that could be time bound because unfortunately these guys are always cash starved, right? The other is the more, if I may say, the more conventional working capital requirement, the growth requirements, and so on and so forth, right? I'm assuming that these are the latter is the bigger amounts also, right? They are regular, but not as regular. Do you tend to focus on one of the two? You blend both because you're building a relationship. So at the end of the day, you don't see the difference. Do the products look different? How do you look at this differently?
Okay. I think the right way to look at this is your core business model is two, which is you're financing the core working capital needs. They come back to you every single cycle. You know them enough, and then you can selectively open up product one, right, which is what we can call an opportunistic loan, right, which can be used either for expansion or seasonality in the business or other purposes. Anybody doing just one is the equivalent of a pawn shop model, right? Nothing wrong with doing it. People do it and they do it extremely well, but very, very difficult to do it under a fintech model using data, right? Because again, it's not about which is the right model, but more about which is the right model for us.
For us, yeah, that's what I was going to say. Right, what's the right model for you? Because at scale, these businesses start to look very different.
Yes,
Right.
because when let's say somebody comes and says, I suddenly need money because of XYZ, there is no data that I can use which a machine can process and give me the result.
It's interesting how I've seen in certain markets where they don't have the guys the Validus model or either number two model, they tend to sort of start with the first, right? It's kind of like, let's give them an access to a virtual IBAN, right? And through that banking relationship, get some overdraft facility, and then start giving them more of these sort of episodic loans, which are sort of low value, and build data on the back of that, and then sort of migrate to number two. But I think you're completely right. If you're able to get scale in number two, you should be able to start servicing for one because you're underwriting someone for a much more substantive amount, and you're sort of addressing a problem. This begs
Because
the question.
we did
Yeah, sorry.
start with one
Right.
and realized we could never turn it into a scalable fintech model.
Okay. Right. And fair enough, right? Because there are such unique requirements and unique sectors and unique subsegments. I want to talk about competition. I know we can go on for hours and hours because I'm just a sucker for learning on this topic. I just find it fascinating. But competition must have grown, right? The bad thing of being successful yourself, for 10 years is that others are looking and saying, hey, if these guys can do it for 10 years, why can't we, right? These competitions come in. I guess these competitors are knocking on the doors of the same anchor partners as you guys, right? And also speaking to some of the SMEs, either indirectly or directly, right? How is the competitive environments? Have you seen that evolve for you guys?
It's been really interesting, right? And very, very contrary to what I would have thought 10 years ago,
Okay.
and to what probably you believe also, which is when the model started around the 2015 2016 mark, there was an absolute rush of players coming in. Why? Because there was no barrier to entry, right? All you had to say was, look, I'm a fintech, I'm addressing the SME lending market, and VC capital dropped from the sky. However, not a lot of people realized that peer-to-peer lending was not a business model. That was just a structure to get access to capital. And without the right model, you know, most players did not perish. So a small market like Singapore, at that one point of time, there were 25 players, right?
Wow.
Eventually, it came down to two. Similarly, in Indonesia, more than 100 plus licensed lending fintechs. I doubt there would be maybe even six or seven credible names operating now. So competition has actually evaporated. which is not always a good thing because it creates negative overhang on the industry. What is the future, etc. The second is our business model, and we ourselves struggled with this model for a long time because, like you said at the start of the podcast, right? It sounds very basic. It doesn't sound sexy or exciting saying, there is an SME who will download an app and then, the app will shake your hand and, give you $100,000. And that is what the VCs wanted to hear, right? They wanted to hear we are connected everywhere, everything is happening using AI, big data, etc. And it took us a very long time to convince investors that, look, this was the model to go. So a lot of startups who actually, what I call selling beautiful PowerPoint dreams, raised a lot more money and eventually did not survive. And now when we talk about our model saying, look, we have 150 anchors, we've done 5 billion plus of lending, it sounds like, oh yeah, I mean, this is so obvious. But today, if somebody wants to copy the model, well, you can, it's an open market, but you will have to go through the same 8 9 year cycle that we have gone through, which is painfully go make those partnerships, collect the data, build models, start lending, calibrate the models as you go till you reach a stage where you can do, a few $100 million a month, without fail.
Interesting, and I don't know. Maybe every market has to kind of go through that flood of players and then a little bit of consolidation. Because as I see the Middle East, right, all I can see is this flood of crowdfunding,
Yeah.
based sort of lenders entering the market. There are 8 or 10 country X's sandbox, and remember, our economies are the size of the economy might be large, but if you take out the oil economy side, right, and the large corporate economy, the economies are not that big, and the number of
Yes.
SMEs are not that much compared to a country like Indonesia, or Thailand, and you've seen that curve. Fascinating. So it is contrary to what I would have imagined. I would have expected a lot more competition. But I do think that industry or that sector overhang does create some challenges, I'm
Yes.
assuming, right? I'm assuming it creates some amount of skepticism, even with people providing you credit, at least in the initial instance, till you build sort of the track record with them, right? Or are they sort of happier saying, hey, no, we just have to deal with these 4 or 6 players, and so therefore we can get to know these players a little bit better?
I think for us, luckily, we have achieved enough scale, credibility, and brand when the industry is seeing headwinds. Because now what we are seeing among institutional lenders is what we call flight to safety, which is as more and more fintechs start to crumble, the banks gravitate towards just partnering with maybe the top two in each sector. So while we know a lot of fintechs are facing a lot of liquidity crunch, uh, just in the last 30 days alone, we have upsized our facility with two international lenders for Indonesia.
So, Nikhilesh, what's so special then? Tell me, is it about your algos? Is it about your tech platform? So what differentiates you? And my question is loaded because I'm going to ask you that. My question
Oh, yeah.
is, if it's exportable, right, as an infrastructure play or an operating model play, is that something which is on the cards?
If you are a large corporate or a bank, you have all the resources to build everything. When you have a startup, you have nothing. You have no VC money to build your organization. You have no professionals to convince them to join, and you have no institutional money to do lending. And unfortunately, all of them want to hear a different story. So the VC wants to hear a very beautiful, high tech, jazzy story. The bank wants to hear exactly the opposite, which is no jazz. I'm working with corporates, I'm getting data, I'm doing very safe lending, right? So I think we are just now in the right space where the banks who have been working with us find that, look, this is a product that is safe. Money comes back every 45 days, so there is no funky accounting there, and they enjoy that experience, and we build that trust with them, right? For the VC or the institutional equity investors, now at least there is some track record where the model has emerged as a model that has survived COVID, survived the interest rate hikes, survived political uncertainty in Indonesia, etc., and therefore has proven its resilience. So I think sometimes it's not about having something amazing. Sometimes it's just about not dying, right? And we used to say this internally, which is that, look, we don't need to outgrow everybody. We just need to outlast everyone.
Yeah. What was that sort of song? If it doesn't kill you, it makes you stronger, or something like. Maybe that's the motto. I forget the name of the singer. My daughters won't be impressed with that. What about exportability? Do you think what you've built here is exportable without you guys?
This question also comes up every time we look at starting a new country. The broad answer is yes, but dot dot dot, right? Is the model exportable? Yes. It is exportable wherever there is a large clutch of SMEs and there is institutional capital available, right? Because unfortunately, I really do not know much about the MENA economy. But if it is anything like, let's say, an Australia or a Singapore, where most of the money is controlled by three or four banks, right, then it is very difficult to build a business because those banks, unless the regulator really pushes them, will never do anything to open up, right? So then you get stopped for capital. So the model itself is exportable. However, there are always local nuances around regulation, right, which will always be slightly different. So you have to build a model around it. The second will be trying to identify what are the right sectors for that particular economy, finding the right anchors, right? For example, let's say the entire distributor financing economy, right? Um, if you are in, I don't know, a Dubai, where all the shopping is being done at supermarkets or convenience stores or the Walmarts, etc., and there are no mom and pop shops, which means Unilever is selling directly to them. There are no distributors to finance.
Fair enough.
So
No,
there
but
have to be
I
a
think
few
your model
checkboxes.
is highly exportable to this part of the world. There are loads of local nuances, and to be honest, there is no, in my view, there is no MENA. It's you got to go country by country,
Yes,
right?
yes.
Because maturity differs, supply chains differ, regulation differs, even behaviors among SMEs
So
differ.
North Africa, Latin America, large parts of Asia, definitely yes.
Yeah, no, definitely. So, final couple of questions. Firstly, we got to talk a little bit about the disruption on the global supply chain on the back of the tariffs, whatever tariff wars or trade wars or whatever they're called these days. I can't keep up with it. Are you starting to see some impact on the business at all, or you guys are isolated largely from it?
Uh, Direct, no, because we were never in that import export economy. So
Okay.
no direct impact. But yes, if there is a broader economic slowdown in the countries where we operate, then there is a trickle down effect,
So
right? Because the common man starts to consume less, starts to move from the higher priced product, switches to a lower priced product, etc., etc. But that is a very slow trickle down effect, not a knee jerk reaction like we see with the tariff economy.
okay, my last but one question, and how can we ever have a podcast and not drop the AI bomb, right? 10 years in, one could argue you have legacy infrastructure now, right? Right. And everybody says that, hey, uh, we've been using versions of AI, whether it's machine learning or something like that for years. But the truth is that, as we progress into, truly embracing Gen AI and then sort of looking at agentic and so on and so forth, AI goes from being the peripheries, the productivity, the enhancers to more of a foundational layer, right? So big words from me, right? Half the time I don't even know what I mean by saying what I mean by foundational layer, but not to be facetious, I think you get it. How do you perceive all these sort of frontier tech? And we talked about blockchain a little bit too, right? I'm assuming there is a role for blockchain to possibly play in tokenization of, real world assets, and then being able to lend against it, and tokenization of the supply chain, and so on and so forth. So how do you guys deal with all this sort of new tech coming in and injecting it into your sort of business model?
I think I would probably be disappointing a lot of people by saying that, look, yes, AI will change the world, but how and in my lifetime, I don't know,
Okay.
right? Because every industry, every company doesn't need to become an AI champion overnight, right? So the economy within which we operate is we have corporate partners on one side or anchors,
Mm-hmm.
right? And within the anchors there are big, small, and medium, and then we have really unsophisticated borrowers on the other side, right? And then the banks, right? So if you look at these three stakeholders, I don't see any of them overnight adopting or getting disrupted by AI in a big way. So my universe is secure, right? Then the question simply becomes, okay, how? do I adopt AI? So the way we look at it is, and we run projects as we speak, is to look at every part of business operations and asking ourselves, can AI or some AI enabled tool be used here, right? Maybe to automate a process, to reduce certain workflows, or reduce or optimize manual workflows, right? But will we change all our programmers and instead do vibe coding? The answer is no. So, all in all, we will probably not be a front runner when it comes to AI. We will not be an AI champion. We would rather be an AI laggard where we will wait and see, right? What are some really good, easy lift and shift use cases that come and we can adopt them. Because
No,
again, right, nothing
fair.
right or wrong. There are some industries where you will be left behind if you're not a front runner. I don't think ours is one of them.
Okay. No, and fair enough. And I think there's no harm being a laggard or a fast follower or whatever the term is these days. And I think increasingly I'm actually starting to hear more and more of what you are saying, where they're saying yes, there's a lot of noise around it. There are some very simple use cases we can definitely introduce, and some evidence exists whether it's taking out. I think wherever there's arbitrage or productivity, as I call it, I do think that there are significant opportunities by being able to use some of the tools. I think where we're talking about arbitrage of knowledge, right? And apologies, these are my sort of analogies where you actually start injecting or depending on AI to replace sort of the knowledge elements that you built. I think there is an augmentation game that you can play, but I don't think it's a tear and replace kind of scenario just yet, right? Because your entire business model then sort of I guess needs to be rebuilt and so on and so forth. So Nikhilesh, last question. Where are you heading next, mate? You've just sold your business in Singapore. You're a rich man, I guess, already. 10 years at SME. What's next? What's the next few years for Validus?
Okay. I think first I need to shed a tear
Okay.
because we sold our Singapore business. All the proceeds came back to the holdco. We are reinvesting those to grow Indonesia or Thailand. So as a team, we don't make anything, but that's okay. We are in it for, I think, the long haul. I think immediate plans are to focus on these two countries
Okay.
because Singapore for us was not a profitable business. We built a beautiful business. It was doing really well. But just given the size and scale of the market, which is really small, high costs, we could not break even here. So as part of that sale, we've got a good amount of cash. We've done away with a lot of burn and turned operating profitable. So that's a good feeling. I think our immediate target is to deliver the first full year of profitability, right, without funky adjustments. And the moment you add that caveat, we'll be among very few tech companies who can deliver that. The second is continue to grow, inch as close to that $1 billion loan book mark, deliver at least double digits PAT.
Mm-hmm.
I think once we do that, then a lot of questions come to us, which is, what's next? Do we add a new market? There is Malaysia, there is Philippines, which have size, scale, enough demand. Do we look at interesting pivots, which is like you said, build ecosystems, right, or adjacent products, and we always explore some of them, always running small pilots to see what works, what doesn't, or really take a very big pivot, which could be saying that, hey, why don't we become a digital SME bank? Because there is almost not a single one in the region which is of any scale or consequence. 90% of digital banks are consumer focused. One or two which are SME focused are really not making a dent.
Yep. Hey, let's put it this way. They're all interesting questions to solve. And I think there's arguably that these are not mutually exclusive either. Because I guess, one sort of feeds the other in a lot of ways. It was a very interesting conversation. I was with the CEO of Starling 2 weeks ago. And, and he was telling me, he's like, my real growth and success has actually come in the SME segment, right? He says, we're growing the consumer segment, but, where we've really, really impacted and taken a significant share, it's SME. We have another great story at Oak North, again, two UK-based businesses. And then you go across the world and you start saying that, there are a number of these banks who have actually built a very strong SME proposition. And then there's this sort of perverse angle, which is there is this B to B to E, E being employees of these SMEs. And in a significant percentage of the market, nearly 70 to 90% of the bankable population actually works for these micro and small businesses. right, and medium enterprises. So there is that sort of argument that, if you could get the I guess the business to be your customer, there is a probability that you could build a consumer proposition on top of it, right, where the real need exists. So
Which was the adjacencies that I was speaking about, right?
right.
Which is their bank accounts, early wage access, personal finance, because you already have a hook in there.
Yeah, and I think we have we have a couple of very good EWA players, right, in this part of the world. It's quite interesting. They started at EWA and then have had to go into sort of SME because they realized that actually once they sign up the SME from a salary processing perspective, but then they realize that actually the SME itself has needs, and if they've built that relationship in terms of sort of guarantee of payment and so on and so forth, well, why can't we actually even first start by just financing the salary itself, right, and then we sort of go from it. Nikhilesh, thanks a lot. I appreciate you making time. I guess it's also getting late in the evening for you. I will call on you in Singapore. Singapore used to be a second home for me for about 5 years of my life before I sort of made my pivot and went back into consulting. But if you ever find yourself in the Middle East, I'd love to introduce you to some of my clients. Actually, that's kind of my job. My job is not, I'm not a podcaster. But this was a joke, which is supposed to be 12 episodes. Now I'm on the 140th or 50th. I've lost count, but it's a lot of fun. I learned a lot. But we'd love to showcase the work that you guys have done. The fact that 10 years is actually an awesome achievement. So sort of well done to you and your team. It's quite great. So thank you for making the show.
No, thank you. It's been really good, and I would love to carry on the conversation. Over a cup of tea.
My pleasure. All right.
Perfect. Thank you so much.
So, ladies and gentlemen, that was Nikhilesh, who's the co-founder and CEO of Validus. Interesting story. This season we are going to talk about the SME world a little bit more, because I do think that it is the big question that the future of finance and technology sort of faces. But with that, I'll say goodbye till next week. Bye bye.